In 1995, a single trader brought down a 233-year-old bank in a matter of days. Barings Bank had survived wars, financial crises, and centuries of market change. At its peak, it was one of the most established financial institutions in the world. But inside its Singapore trading desk, massive positions were being built without proper oversight. Losses began accumulating, but instead of being reported, they were hidden inside internal accounts. To recover, those positions were increased, turning losses into even larger exposure. When the market moved against those trades, the scale of the problem became impossible to contain. Within days, losses exceeded the bank's entire capital base. What followed was the collapse of one of the oldest banks in the world, caused not by external shock, but by a failure of control inside its own system. Barings Bank had operated for over 2 centuries, building a reputation based on stability, trust, and disciplined financial operations. By the early 1990s, it expanded into derivatives trading through a Singapore-based futures desk. This desk was responsible for executing trades linked to major Asian markets, including the Nikkei index. Nick Leeson was assigned to manage trading activities, but he was also given responsibility for back-office settlement functions. This meant the same individual was executing trades and reconciling the accounts that reported those trades. In a properly controlled system, these roles would be separated to prevent manipulation or concealment. At this point, the structure already contained a critical weakness, with no independent verification of trading activity. The system appeared functional, but it relied entirely on trust rather than enforceable oversight. Early trading losses began to appear on the Singapore desk as positions did not move as expected. Instead of reporting these losses, they were transferred into an internal account that was not closely monitored. This account allowed losses to be separated from official reporting, keeping the main trading books appearing profitable. At this stage, the amounts were still manageable, and recovery seemed possible through future trades. To offset the losses, larger positions were taken, increasing exposure rather than reducing risk. Because the same individual controlled both trading and reporting, these changes were not independently verified. What appeared to be stable performance at the institutional level was already diverging from reality. The system was now dependent on recovery through continued trading rather than transparency or control. As losses continued, positions on the Singapore desk were expanded further in an attempt to recover previous deficits. These trades were concentrated on movements in the Nikkei index, increasing dependence on a single market direction. Leverage amplified the size of these positions, allowing exposure far beyond the capital allocated to the desk. The hidden account continued absorbing losses, preventing senior management from seeing the true risk. At this stage, reported profits created the impression that the strategy was working. Internally, however, the scale of exposure was growing to a level that required favorable market conditions to survive. The system was no longer managing risk. It was relying on a specific outcome to avoid collapse. By this point, the problem had moved beyond individual trades into a structure that could not tolerate adverse movement. In early 1995, market conditions became unstable following the Kobe earthquake in Japan, increasing volatility in the Nikkei index. Instead of reducing exposure, larger positions were taken to recover existing losses under more uncertain conditions. This increased the size of potential gains, but also magnified the downside if the market moved further against the trades. At the same time, reporting continued to show controlled activity, masking the growing imbalance inside the system. The gap between reported performance and actual exposure widened rapidly. Liquidity was still available, allowing positions to be maintained, but not without increasing risk. The system now required the market to reverse direction in order to stabilize. What had been a concealed problem was now dependent on conditions outside the bank's control. As the Nikkei continued moving in the wrong direction, losses accelerated beyond any realistic recovery level. The scale of exposure had reached a point where even small market movements resulted in massive financial impact. Attempts to recover by increasing positions only deepened the losses as the market failed to reverse. At the same time, internal reporting still did not reflect the true size of the problem. By the time discrepancies began to surface, the losses had already exceeded what the desk could contain. There was no longer a viable path to offset the positions through normal trading activity. The system had moved beyond control, with risk concentrated in a single direction. At this point, the outcome was no longer uncertain. The collapse had effectively become inevitable. When the true positions were finally uncovered, the scale of losses was far beyond what Barings Bank could absorb. Total losses reached approximately £827 million, exceeding the bank's available capital. Because the positions were highly leveraged and concentrated, there was no way to unwind them without locking in the losses. Creditors and counterparties began recognizing the exposure, increasing pressure on the institution. The bank could not raise sufficient capital in time to stabilize the situation. What had been hidden within a single desk was now impacting the entire balance sheet. Operations became unsustainable as liabilities exceeded assets. Within days, the institution was effectively insolvent, driven by a failure that originated from a single, uncontrolled system. In February 1995, Barings Bank officially collapsed after more than 2 centuries of operation. The institution was declared insolvent as losses exceeded its entire capital base. Shortly after, the bank was sold for £1 to ING Group, ending its independence. The collapse was not caused by external market conditions alone, but by a failure of internal controls and oversight. A single trading desk had been able to take on exposure large enough to bring down the entire institution. The event exposed how concentration of authority and lack of verification can override even long-established systems. What had been considered a stable institution was undone by a structure that allowed risk to remain hidden. The outcome became a defining example of how control failures can lead to immediate and total collapse.